what to make of a market that so far has been tough to rattle, even in a bumpy stretch for economic data and with some signs of froth surfacing in its more speculative corners. Let's ask Cameron Dawson, NewEdge Wealth Chief Investment Officer, and Courtney Garcia, Payne Capital Management Senior Wealth Advisor. Courtney, also a CNBC contributor. So welcome to you both. Cameron, coming into this week, it was possible to say we had hit a lot of levels that said mission accomplished, 5,000 on the S&P, 18,000 NASDAQ 100. Bitcoin crossed above 50. We're looking for an excuse to maybe have a pullback. Many would have said, I would have said, we got one day 1.3% on that CPI number, and we picked it up. So is the market ignoring something, or does it show underlying strength? What's your read on that?
I think there is still very strong momentum in this market, and that there is still room for positioning to get more long. You're still in about that 85th percentile on positioning, according to the Deutsche Bank Consolidated Positioning Report, which just says momentum can keep on chugging along until you reach that point where you're at an extreme. I think the other important point is that it's not been about growth. There have not been growth fears that have been percolating, which just means that any kind of correction seems short and shallow and more to do with Fed expectations and really doesn't have that teeth in it that you would expect to see a deeper pullback. Yeah,
I mean, there's no doubt we've had enough months of pretty resilient economic numbers to suggest that we're not going to panic out when you have a slightly soft retail sales report, which is what we had there. And Courtney, I guess the question, too, is has the market answered some of the questions that people had for it? Meaning, I mentioned the Magnificent Seven down this week. I mean, Alphabet's down like 5+% on the week. Adobe's been tough. You had NVIDIA hanging in there, semi-cap doing fine. But the average stock has done better over the last week. So the question is this another head fake? Does it show that we have something underlying here, or again, is it noise?
Yeah, and I think really investors have been rushing to those Magnificent Seven. Everybody thought this rally was going to broaden out, and this year that hasn't come to fruition. But weeks like this week are showing it may actually happen. There's still so much money on the sidelines. There's now over $6 trillion in cash right now. That's eventually going to make its way back into the market, because what's happening right now is, even though maybe with this CPI and PPI number, inflation isn't going to come down as fast as people thought, it still is likely going to come down later this year. And so that money is going to come out of there, and it's going to go into some of those other sectors. What's happening is those Magnificent Seven are extremely expensive, right? I mean, just to put it in perspective how congregated these are getting, those 7 stocks are now bigger than the entire European stock market. Microsoft is bigger than the entire energy sector. I mean, people are rushed to those things. So with that cash coming off the sidelines, it's got to go into some of these other areas. You want to own the Mag 7, but if you haven't done anything, you're already overweight there. So you need to start looking at these other categories.
I did see, in the Bank of America's weekly kind of tracking of flows, there was some maybe $18 billion coming out of cash. I mean, a small amount, and you've had some flow. And the only real category of ETF equity inflows has been in tech. So I guess that's where the chase is happening. And Cameron, you did mention Fed expectations are the one thing that's really been moving around. And this has been a bit of a test case, because there was a common line at the start of the year that says market's ahead of itself, thinking about 6 or 7 rate cuts this year. Turns out, yep, that's probably right. The market's now at 3 to 4, and yet stocks have held up fine. In fact, let's listen to what Raphael Bostic of the Atlanta Fed today said about kind of his stance on this and what he's expecting next.
We've seen a lot of progress in terms of inflation. I am expecting that through the course of 2024, it'll be a little bumpy. I think the trend will continue, but the path all the way to 2%, I don't think we're going to get to that number immediately. So these sorts of numbers, they're kind of okay, and I can live with it. And to me, it just says we just have to be patient, and let's not get too far ahead in assuming that the job is done, because there's still work to do.
I mean, and this has been a very consistent message. I mean, every single Fed official is on this page. And so I guess, has the market proven that this is acceptable? In other words, as long as the next move is lower, and as long as there's no economic emergency that they're not responding to, we can wait.
The market has been shrugging off a tighter Fed for over a year now. Over the course of 23, the Fed was consistently tighter than what the market expected, and yet valuations continued to expand. I think that the thing that would get the market to get more skittish around the Fed is if inflation truly did reaccelerate in a much more meaningful way, which means that we have to watch those prices paid in the PMIs. We've seen those tick up recently. Gasoline prices have started to move up about 7% over the last month. month. If that starts to move in the other direction, the Fed's tone will move from, yeah, it's okay, we're comfortable with this, to we might have to do something else, and all of those cuts priced in have to get priced out, and then maybe the market would wake up to that kind of risk. But that remains to be seen.
So to recap it up, we've got $6 trillion coming back into the market, guys, sitting on the sidelines. Cameron Dawson says momentum can continue until we hit extremes. We're not having growth problems in the stocks, so that's good. This week we did have Google and many others down about 5+%. Wondering if there's any underlying problems there, if it's just a normal sell-off. This year, the markets went from expecting 7 cuts to 3 to 4 cuts, and we're still holding up pretty good. So that's pretty decent. We have to be patient. There's still work to do. That's what the Atlanta Fed official said. If inflation reaccelerates, then we need to get worried. I think we all know that. We had some upticks in CPI this week, but hopefully we don't have multiple consecutive readings in a row that are hot. We've got the $6 trillion coming back. Courtney thinks the Mag 7 are extremely expensive. I don't agree with that. Just based on PE ratios, based on how much AI is about to change these stocks, literally inside and out, there's no way that they're expensive, and that's why she also, to her other point, most people are overweight in the Mag 7 stocks. Well, why wouldn't you be? They're just outperforming the market, and AI is about to hit them the best and the hardest. Either way, overall, we need to be patient and buy the dips. There's a lot of money coming in and a lot of rate cuts coming, and AI is just starting to take off, guys. I hope you enjoyed the video. I'll catch you in the next one.